Hi everyone, welcome to the latest edition of the Catapult Wealth updates. This one specifically is about tax planning before the end of the financial year. The primary message here is to make sure you don't leave things too late. Contact us to check up on what you need to do before the 30th of June. It's always a nervous time of year, just making sure you've ticked all the boxes and everything that you can possibly do before the 30th of June is done. It also can be an interesting time of year because as clients go away or you're planning holidays and you may be away at the crucial times, that you get your tax planning in order before you take those well-earned holidays. So a few points that I just want to go through today just to highlight. Some of these will be relevant to some of you and others may not be relevant, so bear with me. First thing, and crucially always, making sure that if you can look at some of your investment loans, if you want to look at prepaying interest for the next 12 months, that can be claimed as a tax deduction in this financial year. That means just a conversation that you have with your bank or a lender. So that's certainly one thing you can look at for those that have loans. You can look at certainly trying to avoid the Medicare levy surcharge for those that it's relevant for. If you don't have private health yet insurance, you can certainly take out private health insurance, which will get rid of your Medicare levy surcharge. Make sure that you've looked at your capital gains tax issues if you have any. If you've bought and sold shares throughout the year, ensure that everything's been done to try and minimise the capital gains for those assets throughout the course of this financial year. A key one is salary sacrifice. If you can sacrifice some of your salary up to the limits, which for us, anyone under the age of 60 is $25,000. Anyone over the age of 60 is $35,000 in this financial year. But if you are salary sacrificing, you can lower your income down and pay only 15% marginal tax by contributing it to your super fund. Be very careful though of timing. Some employees paid bonuses or businesses paid bonuses around this year, which you've got to be careful about if you go over that $25,000 or $35,000 limit. If you turn 55 during this financial year, please consider whether it's time for you to look at a transition to retirement strategy. This is not necessarily right for everybody, but certainly should be considered, and a conversation with us here at Catapult Wealth about whether it's suitable for you or not needs to be had. If you turn 60 throughout the year, it becomes a must-have with your pension, putting your super fund into pension mode as your income from that you must draw down out of your super fund after that age is non-taxable, and this can save you a considerable amount of money. For those that are close to turning 65, it's your last chance to put that large non-concessional tax-free contribution into superannuation this year, $450,000, which is your 3-year bring forward rule. So that needs to be considered for those that it's relevant for. Don't forget the government co-contribution, up to a maximum of $500 the government will share or put in your super fund for you if you put that amount in as well. Make sure that it only applies for those that put in a non-concessional contribution of $500, and if you're earning between $33,000 and $48,000 a year in income. Don't forget about this low income rebate on your super tax. If you're earning up to $37,000 and have contributed to superannuation this year, the government will rebate your 15% tax on those contributions going into superannuation as well. Certainly, the last point, I also want to just looking forward into 2014-15 for those that are looking forward. The rules around the contributions into superannuation are changing. For anyone as of next financial year, in the 14-15 year, that have anyone under 50, the new tax deductible limit changes from $25,000 up to $30,000 next financial year, and for those that are over 50, it changes to $35,000 for anyone over 50. The non-concessional amounts also change. The amounts you can put in as a lump sum tax-free into super changes from goes up to $180,000 per annum and also that 3-year bring forward rule goes up to $540,000 per annum. There might be some queries you have with regard to what we've quickly mentioned here today. Please contact us here at Catapult Wealth and we can walk you through any queries you have and whether some of these issues are relevant to your circumstances. Look forward to a busy couple of months ahead, getting everyone ready for the 30th of June. Hope everyone's well out there and look forward to speaking to you next time. Thanks.